Well, good morning. Yes, it's me, Kenny Polcari, your host of the party. And today is Thursday, October 30th, 2025. And here are the things that you need to know to get your day started. Well, JJ is really a hawk. Who knew? Odds of a December rate cut now plunge overnight, and quantitative tightening is dead, at least for now. Once again, the indexes are telling a very different story. Gold ends lower, bonds lower, and yields shoot higher while oil holds steady. And Meta and Microsoft and Google, well, they're behind us. It's now Apple and Amazon that are in front of us tonight after the bell. And what are we having dinner tonight? We're having the Veal scallopini. Okay, so what looked like a dove is really a hawk. I guess that's what we learned yesterday. JJ came out swinging, telling us point blank, and I quote, "In the committee's discussion at this meeting, there were strongly differing views about how to proceed in December. A further reduction in the policy rate at our December meeting is not a foregone conclusion. Far from it. Policy is not on a preset course." Oh boy. Now, that line changed everything. Until he said it, the futures markets were pricing in a 90% chance of another rate cut in December. But as soon as those words hit the tape, the odds plunged to 50%. And the algos, well, they didn't take kindly to that at all. In fact, as usual, they didn't like it. In addition, JJ told us that while they're going to stop the shrinkage of their treasury holdings, all right, at $5 billion a month, essentially ending QT beginning in December, on December 1st. But they will continue to allow their portfolio of mortgage-backed securities, the MBSs, to run off at a $35 billion rate per month. The runoff will be reinvested back into the treasury markets to help maintain stability. The move comes as the funding costs have been rising, causing the Fed to reconsider the plan to avoid the same reaction that we witnessed in September 2019. Now, while he did not admit that the system is under stress, the move is clearly an acknowledgement that they are concerned. And that concern will most likely be reflected in stock prices over the next coming days, right? Then came the kicker, the dissent. Stevie Mirren naturally voted for a 50 basis point rate cut. We knew he was going to do that. He all but said it, carrying a sign for the last couple of weeks, while Kansas City's Jeff Schmidt voted to do nothing at all. And that was really the surprise. That's the first time in decades that the Fed has had two dissenters pulling in opposite directions. One screaming, "cut more," the other one saying, "stop already." And that, my friends, was the pivot. The narrative flipped from the Fed's easing to maybe they're not. Bonds got whacked, yields spiked, gold got sold. Think stronger dollar, right? And the broader market went from up to down in a flash. Now, the day wasn't a total disaster, right? NVDA became a $5 trillion company, and that helped the NASDAQ and the Mag 7 stay in the green by the time the bell rang. There was also the anticipation of Meta and Microsoft and Google earnings after the bell, and that kept the algos and the traders kind of on the edge of their seat, not really knowing what to expect. But the rest of the tape, well, it bled. The Dow ended down 75 points, a 400-point swing off the high. The S&P finished the day flat. That's important, so listen. The Russell lost 22 points, down 1.2%. The equal-weighted SP dropped 1.1%, even as the market cap S&P looked like it was unchanged. Again, showing the divergence between the real market and the Mag 7 driven headline market. And the sectors told the story. Real estate, XLRE got crushed, down 2.7%. Higher yields, plain and simple. Consumer staples, down 2.4%. And you ask why? Aren't they supposed to be defensive? Sure they are. But here's the rub. When JJ took the December rate cut off the table, bond yields shot higher. And higher yields instantly reduced the appeal of those slower growth, dividend-oriented names. That's all. Doesn't mean they're bad. Just means that's what happens, the math. Basic materials down 2%. Financials down 1.7%. Healthcare down 1%. Consumer discretionary down 0.8%. Comms was down 0.25%. The only green on the screen came from industrials, which are only up 0.25%. Energy and tech up 0.7%. So yes, what looked like a dove turned out to be a hawk in disguise. Let's just see what happens today. And here's a peek. Futures are lower across the board. In the end, JJ pulled back the sheets to expose what we all knew. The goal to manage and satisfy the dual mandate, maximum employment and price stability, is proving to be tricky, and my bet says that the Fed is willing to put up with higher inflation to protect the labor market, which is a bit confusing, at least for me at the moment, because right now the labor market does not appear to be in trouble. Unemployment again is 4.3%, not 5.3%. And unless maybe they've got some inside information that the rest of us don't have yet, but that's just something to think about. Now remember, 4.3% is considered full employment. Dovish? In any event, the announcement sent the bond market reeling. The TLT lost 1 full percent. The TLH fell by 0.8%, pushing yields sharply higher. The 10-year yield rose 10 basis points, right? A fairly aggressive move in the 10-year from 3.97 to 4.07, while the 30-year rose 8 basis points to end the day yielding 4.62%. Gold, which had seen dip buyers in the morning after the recent pullback, got whacked again, closing only down 22 points at 39.30. And that doesn't sound so dramatic, but remember, the morning dippers were paying $4,030 an ounce before the Fed announcement. So that was a $100 intraday swing. This morning, the dip buyers are back, taking gold back up $50 to 39.81. But I think this strength gets sold as JJ's new narrative kind of gets dissected and then digested. Gold's recent run was driven by expectations for both an October and December rate cut, as well as rate cuts early in 2026. That's now up in the air, which is why I think we go lower before we go higher. Unless, of course, we get some kind of clarity on the statement. And here's the next thing to watch. The blackout period for the Fed members is over, so expect a full parade of Fed officials hitting the circuit, right? They're going to hit all the TV programs, each with their own interpretation of what went on behind the Iron Curtain and what they think happens next. That, my friends, is sure to create another round of volatility for the markets, right? Because they're all going to tell you what they think should happen. Meanwhile, none of them are the chair. Oil's holding steady at 60.20. There's really nothing to see here. There was no movement at all. This morning, U.S. futures are lower. Dow futures down 122, S&P's down 9, the Nasdaq's down 30, and the Russell is flat. After the bell, we heard from Meta and Google and Microsoft. Meta is trading down $7 or nearly 9% at $688 a share after they announced a rise in CapEx spending that is spooking investors, right? Do you think? Markey is paying these guys $1 billion pay packages. The return on investment clearly still unknown. The stock is trading down and through the short and intermediate term trend lines and is about to test the long-term trend line at $678. Will it hold? Well, we're about to find out. Google's up $20 or 7%, while Microsoft is down $20 at 3.6%. Nothing in there is going to make me change my mind on those investments. So far, we've heard from 25 more companies this morning, and the beats continue. Only 4 have disappointed. Eli Lilly rockets higher, up $37 or 4.5% after announcing that sales of Manjari and Zepbound are surging, causing them to raise their guidance on revenue and earnings per share. We will hear from Apple and Amazon tonight after the bell, so stay tuned. Now let's see if this ongoing better than expected earnings season can blunt some of JJ's narrative. European markets are all lower this morning. The ECB is expected to hold rates steady today when they announce, and like here, there's the deluge of earnings reports to pay attention to. Trump had a successful meeting with Xi apparently overnight, agreeing to extend their tariff truce and roll back some of those export controls. China has agreed to cooperate with the U.S. over a fentanyl crisis, and they have resumed buying soybeans and other agricultural products from the U.S. So looks like a win, another win for us. The government continues to be shut down. The Dems have now voted 13 times to keep the government closed, and it's now getting ugly. You can feel the tension building. Senator Thune read them the Riot Act last night, told them to smarten up. Schumer wants none of it, and so the shutdown continues. Newark Airport came to a complete halt yesterday afternoon. Think a work stoppage due to staffing issues, right? Remember, these guys are calling in sick, and I don't blame them. There's, what the government is saying is there's no paycheck for you, but there is a paycheck for Schumer and the squad. Now, the S&P closed at 68.90, essentially flat on the day, after teasing as high as 69.20 in the early part of the day. This morning, the action suggests a weaker open, but we know how that can change on a dime, especially if the markets dismiss JJ's narrative, and it might once we start to hear from the other members of the Fed. Remember, once they start coming out talking. In any event, the next FOMC meeting is only 41 days away, so let the countdown and the speculation begin. Now, it's going to be interesting to see what happens today. Will we see more divergence in the S&P or not? Keep your eyes on the equal weight S&P to get a better sense of the broader market move. Now here's your countdown. It's now 30 days of a government shutdown and still no end in sight. It's 30 days until official Black Friday. It's 56 days until Christmas, and it's 62 days until the ball drops in Times Square. Remember, let me review your plan. Give me a call for a complimentary, no obligation portfolio analysis. Always happy to talk about it. 561-931-0190. And yes, you'll get me if you call. Okay, so what do we have for dinner tonight? Well, I decided to change it up a little bit. We're going with the veal scallopini, and today is a veal scallopini in a lemon sauce, which sounds absolutely perfect to me. For this, you need 10 pieces of veal, the veal scallopini pounded thin. You need salt and pepper, flour, butter, oil, dry white wine. You need parsley, fine chopped. You need chicken broth and fresh lemon juice. And you can throw capers on this too if you like. Take the pounded scallopini, season them with salt and pepper, then dredge them in flour, and then shake off any excess, put them aside. In a large saute pan now, melt a half a stick of butter and add a splash of olive oil so just the butter doesn't burn, right? When it starts to foam a little bit, put the veal in the pan and brown it on both sides, 2 to 3 minutes on both sides, and then remove it and set it aside. Now in that same saute pan, add in about a cup of white wine and 2 cups of chicken broth. Bring it to a boil, then add the lemon juice and the parsley, and here's where you would add the capers if you want. Then add the veal back to the pan and simmer for another 5 minutes. You want to serve this on warm plates with vegetables of your choice. Always remember to serve this with a mixed green salad dressed with olive oil, lemon juice, salt and pepper, and oregano. Something kind of simple, clean, but it goes right along with the dish, and it is delicious. In any event, it is Thursday morning, 2 more trading days, and then the weekend comes. Until tomorrow, take good care.